this video, we will show you the Islamic perspective on money and monetary policy as well as the conventional perspective.
Firstly, what is money? Money is primarily a medium of exchange or means of exchange. It is a way for a person to trade what he has for what he wants. Ideal money has three critical characteristics. First, it acts as a medium of exchange. Number two, it is an economic good. Number three, it is means of economic calculation.
Historically, as soon as trade between individuals became common, but there was the medium of exchange.
Money is a good, unit of account, a store of value and a medium of exchange.
Islamically, gold are used as money. It is used as a medium of exchange between trade item and a payment facility. To ease people trade using gold, it is minted according to different weights and fineness.
To ease people trade using gold, it is minted according to different weight and fineness so that it could be measured easily to suit different price items. Gold is very universal. It is accepted anywhere in the world because they have intrinsic value. The most interesting part is gold cannot be created as well as be destroyed. Gold is mined from the earth and it is limited.
So money is not just a piece of paper. It is medium of exchange that facilitates trade.
I will talk about the goal of monetary policy. Goal of the monetary policy is to assist the economy to achieve full employment and non-inflationary level of output. And then I will talk about the tool of monetary policy. The first tool is open market operation. Open market operation has two types. One is buying security, number two is the selling security. For the buying security, bank give up security and federal will give pay for to the bank reserve will increase. Okay, this is for the commercial bank. If the federal buy from the public give up security, if federal will pay to the public and the public will deposit their check to the bank, so the bank reserve will increase. For the selling security, federal give up security. Federal give up security, which is the central bank, and the bank commercial. This is the commercial bank, and bank pay for the security. Bank reserve will decrease.
Okay, now I divide. There are two kind of instrument, which are conventional instrument and new instrument. New instruments are come from Islamic economy, and this the old conventional instrument, and some of instruments are acceptable in Islamic economy. However, some instruments are not acceptable in Islamic economy.
Because in conventional system, the main instrument in the monetary policy is interest rate, which is stabilize the economy. But in the Islamic economic system, interest is prohibited. So what are the solutions? What are the alternative policies instead of interest rate?
For example, profit loss sharing ratio. This thing differs between Islamic economy and conventional economy.
So وكالة وإجارة contracts. وكالة وإجارة contracts. In this contracts, the central bank issues a certificate. By this certificate, the central bank receives funds from investors. So the central bank gets out the money from the circulation of the money from the economy, which is a contractionary policy. But when central bank gets the funds from the depositor, so it buys placable assets and lists them to a third party. So the central bank actually increase the supply of money in the economy. It is an expansionary monetary policy. And the second one is وكالة وإجارة منتهي بالتملك. In this contract, the central bank pays regular installment in the depositor, the money supply increases, and it is an expansionary monetary policy, but it has bigger impact before that, because it is not just income, but it is the principal, which might be more than income. So the third one is مشاركة متناقصة وإجارة. مشاركة متناقصة وإجارة or diminishing contract partnership. So it says that bank and investors, both of them are partners in one asset. So actually, the central bank gets funds from the depositor, which is taking off money from circulation. It is a contraction. It has a contractionary impact. When the central bank buys an asset, it has an expansionary policy, because it spends, it pays money for the owner of the asset, which is the individuals, which are people. So money supply increases, therefore when the money supply increases, it is an expansionary policy.
And for the finance ratio, this is this instrument move in the opposite direction with the cash reserve ratio. It means that in order to reduce the expansion of credit, banks have to reduce refinance ratio. However, in order to increase the expansion of credit card, they have to increase the finance ratio.
Second part is reserve ratio. Reserve ratio also has two parts. Number one is the rising the reserve ratio. Number two is lowering the reserve ratio. If for the rising reserve ratio, bank may hold more reserve, and the excess reserve will shrink. It will shrink, become less, and the bank lending also decreases. The money supply will also decreases. This is the rising reserve ratio. If this is the lowering reserve ratio, bank may hold less reserve, and the excess reserve will expand. And for the third is the bank lending will also increase. They will give to the public people, and also for the other people to loan from them. And also the money supply will also increase.